What's going on, Investomaniacs? Your boy Knight Rider here, and it's time for another stock market update of the day, brought to you by Robinhood. Markets remain concerned over the growing U.S.-China trade war and China's currency devaluation last week to counter upcoming U.S. tariffs. However, on Monday, China pledged to not devalue the yuan exchange rate after the U.S. Foreign Exchange Administration chief designated China a currency manipulator. Pan Gongshen, a vice governor with the People's Bank of China and the head of China's State Administration of Foreign Exchange, wrote, quote, "We will not engage in a competitive devaluation and won't use the exchange rate as a tool to handle international trade disputes." Having said that, on Monday, China's central bank set the exchange rate at 7.02 yuan per dollar, still below the 7-to-1 key maximum threshold China has maintained for over a decade. For the first time ever, mysterious Saudi Aramco revealed its financial details. This isn't big oil. This is the biggest oil. Saudi Arabian Oil Company, aka Aramco, just stuck its financial statements up on the interwebs for the first time ever. It didn't have to. It is not a publicly traded company, but it is trying to pique some investor interest. Here's what Earth's most profitable company looks like. That's right, it's not Apple, it's Aramco. It's private. Saudi Aramco has but one shareholder, the Kingdom of Saudi Arabia, since 1976, when the government took full control of what was then an American company. It is still 100% private today, owned by the Kingdom of Saudi Arabia. Public curious. Back in April, it interacted with the public markets for the first time ever, offering $15 billion in bonds to raise some money for itself. Now public. The Saudi government says it's thinking about IPOing Aramco to sell some shares to the public markets in exchange for cash. That's why it wants to show some of its numbers so investors can check it out. The home run record in one season in baseball was 16, and then the Babe came along and nearly doubled it at 29. Aramco is the Bambino of profits, roughly doubling that of Apple. So behold its elusive financial stats from the first half of 2019. So to reiterate, this is 2 quarters, not 1 quarter. Profits. $47 billion in profits. That is double what Earth's most profitable public company, Apple, made, and almost 8 times that of Amazon. Dividends. It delivered almost 100% of that profit to its one single shareholder as a dividend, so government services for 33 million people could be paid for. The oil, it pumps out 10 million barrels of crude oil per day. Only Russia and the United States produce more oil, and those are countries. This is one single company. Fun fact, it's still got a half a century's worth of reserves to tap into from the ground. The takeaway? Operation Modernize. The next Saudi king, Crown Prince Mohammed bin Salman, was all the rage, trying to modernize his intensely conservative country. For example, women just got the right to drive last year. That is pretty conservative, but it is a step in the right direction. Nonetheless, that plan was just put on ice after the murder of journalist Jamal Khashoggi, believed to be at the Crown Prince's order. Now he's venturing out of the moral doghouse and into the financial world, and people don't really seem to mind. It may just be the biggest IPO ever. Up next, the car industry begins to go all in on electric, phasing out hybrids. Can I borrow your car charger, please? GM and Volkswagen are ditching the hybrid technology that Toyota made famous with the Prius back in the 90s. Shout out Prius. Here's a cheat sheet on conventional versus hybrid versus electric, as some car companies plan to go long on plug-ins and short on hybrids. Conventional. An engine burns gasoline, which creates a bunch of toxic emissions. It's like not good for the environment. And then it like pumps pistons up and down, and that spins your wheels. You know, that's like basically what it does, right? And then there's electric, where a battery powers a motor and makes you go forward. Darn it, Jim, I'm a stock investor, not an engineer, okay? What's the downside? Pricey batteries make e-cars $6,000 to $10,000 more expensive than conventional ones on average. Now, tax incentives were helping out with that, but now those tax incentives are mostly over. And then we have the hybrid. It's a little bit of the good of both worlds. You have a conventional engine, but braking charges a battery which powers an electric motor. It's more environmentally friendly than conventional engines, but doesn't have the range limitations of electric vehicles, which is one of the major concerns over electric vehicles. Hybrid tech costs about $2,000 more compared to conventional, so it's also a lot more affordable relative to the $6,000 to $10,000 extra for an electric vehicle. Hybrid just upped America's miles per gallon, but apparently that uppage in MPG is not enough for the future. According to the Wall Street Journal, the car makers are realizing hybrid just isn't cutting greenhouse gases enough for the future, especially with Europe and China's aggressive environmental plans for the future. Ford, Volvo, and Toyota are retaining hybrid options because some customers aren't ready to completely make that switch to electric. The takeaway: companies can only make so many bets. An automotive CEO has a ridiculous menu of expensive things they could spend money on. Autonomous driving, car sharing, pickup trucks, hybrid and electric. Each buck spent on one thing is a buck not spent on something else. And there's only so many bucks to go around. Electric vehicles will likely be the exclusive option at some point in the future, but most customers aren't ready to make that transition today. So how quickly you believe that transition will happen should influence which car companies you are looking to invest in. Having said that, we're not at the best point in the cycle, and steel tariffs are a very real concern, and I wouldn't recommend any new car companies at this point in time. I do, however, like CarMax and Carvana, the used car companies. Up next, Nike unveils its first Kids Kicks subscription box. 4 pairs of kicks per year for $20 per month. If baby Jordan went back to school, he'd subscribe to get all these fresh kicks. A stealthy sneaker club startup called Easy Kicks has been delivering shoes to 10,000 subscriber families. Turns out, it was Nike all along. Easy Kicks just got rebranded as Nike Adventure Club for kids 2 to 10 years old, and it's Nike's first ever subscription service. The tiers: 3 options. Get 4 pairs of sneakers per year for $20 per month, or 6 pairs for $30 a month, or 12 pairs for $50 per month. The feel-good vibe. Send back the kicks and Nike will donate or recycle them when your kids are done using them. The asterisks, pediatricians say that's way too many kicks even for fast-growing kids. Subscriptions. So hot right now. From Dollar Shave Club razors to Lola tampons, subscriptions guarantee recurring revenue for businesses and build brand loyalty. Plus, customers don't have to worry about shopping or thinking about buying stuff anymore. Now, kid subscriptions are gaining traction because they grow so fast. They constantly need new stuff. It kind of makes sense, right? Here's who else has kid-friendly subscription options currently. Walmart partnered up with kids clothing startup KidBox. Foot Locker invested in KidBox rival Rockets of America. I like the name, Rockets of America. Algorithm-powered fashion subscription Stitch Fix launched a kids version last year. The takeaway? It's all about the upgrade. The biggest surprise for Nike was how offering different price tiers let users test it and then commit to more money down the line. Most began at the cheap $20 per month option, craving more adorably small kicks for their kids. And then they paid up for the fancier tier, only $10 more, and I get an extra 2 pairs per year. Is this a reason to invest, however? If this were a standalone company, I'd probably say no, not having seen the financials. I think the customer acquisition cost would likely be too high, and the market is probably just too small. At the end of the day, it is not prudent for the large majority of Americans to be spending $240 per year on shoes for one kid. But this isn't a standalone company. This is Nike, so just do it. And they have the ability to promote the subscription service on their own website if they so choose to, in their stores, on their social media, etc., resulting in much lower customer acquisition costs than a standalone company. Thus, the risk-reward makes a lot more sense. Plus, many kids' Nike shoes are more than $60, with many pairs reaching into the triple digits. So, if a person is willing to buy expensive Nike shoes for their kids, there is value to be had here. I like Nike without the service. I like it even more with the service. It's a buy. Buy! That's it for this video. I'm trying my best to help put up more high-quality, entertaining investing content for the YouTube community. If you'd like to support that effort, please hit the like button and subscribe. As my channel is still pretty small, every new subscriber legitimately makes a difference. Thank you. Have a great day, guys.